Welcome back. North American stock indices are now up double digits from the October lows of last year, which may leave a lot of potential runway ahead. However, our next guest is a portfolio manager. She does not expect a smooth ride back to the previous peak and says investors expecting the current bull market in shares to continue well into 23 could be in for a rude surprise. We're joined now by Brianne Gardner. She's wealth manager and investment advisor at Volatility Investment Partners at Raymond James. Thanks for coming in. Great to see you.
Thanks for having me, Paul.
What do you think of the rally we've seen so far in 2023?
Yeah, I know. I think what we're seeing is a lot of the sectors that didn't do well last year. You know, if you're thinking of cyclicals like and sensitive sectors like discretionary, technology, real estate, right, really lead this rally. And the sectors that we saw do well last year, like energy and defensive names, utilities, consumer staples, really lag in this rally. And the interesting thing about this is if you look at the consumer sentiment in the markets, right now, consumers are very optimistic. Coming off of December, when we saw consumers the most pessimistic they had been in over 50 years. So even in December, consumers were more concerned about the economy, about the markets, than they were in 2008. So I see it's a little bit crazy to go from that pessimistic to that optimistic in just 2 months.
It seems to be that investors have gone from banking on a soft landing to, in fact, banking on a short recession followed by interest rate cuts this year at the Fed in the most optimistic scenario. What do you think of that scenario?
Yeah, I think a lot of what is driving the market now is a little bit of FOMO, you know, that fear of missing out. And investors, after a bad last year, are trying to get back some of those losses. And I don't necessarily think that that is the best and safest way to be managing money or to be taking on that risk, especially after, you know, the inflation figures that we got. You know, we saw peak inflation happen in June was at 9%. We saw December come in at 6.5. And we were expecting, you know, we've seen 0.4% come back each month. But after the January figures of 6.4, you know, we are seeing a little bit. Could we be in that sticky inflation that some people have been talking about? So I think sentiment is a little bit high considering the background of things. Nothing has really changed, right? We still have high inflation. We still have high interest rates. There's still a lot of uncertainties and recessionary concerns. So I think investors have to be a little bit careful.
And we're seeing booming employment markets still, despite the interest rate hikes that we've seen in both countries. Tiff Macklem yesterday, he's the governor of the Bank of Canada, of course, cited excessively tight labor markets. That's bank speak for there's too many jobs being created in the economy. And in the U.S., most recently, we saw 500,000 jobs created in a single month.
Yeah, exactly. And, you know, when there are almost 2 jobs for every person looking, you know, that also impacts wages for us or people who are looking to pay for employers. And what is really driving the economy is the consumer. So if we're increasing wages, GDP growth, 70% of GDP growth is made up of consumer spending. So if consumers have more money in their pockets at the end of the day, they're going to keep driving the economy forward. So there is this little bit of dislocation. But I would be, you know, cautious of seasonality too. The second half of February, we do tend to see the markets be weaker. Even if you look at 2020, you know, February 14th is when we saw that pullback. Not saying we're in that situation, but seasonality going back to 1950s, we do see the second half of February be pretty weak.
So with all of that in the background, how are you positioned on behalf of clients right now?
Yeah, we have been taking some profits at this recent rally. I do think from a risk-reward perspective, I wouldn't be, buying into a lot of the overpriced and overvalued sectors, which is a lot of them. We are being patient and focused on our active risk management. So I think that's where you need to be patient, wait to deploy some capital, and then I think you will see a lot of volatility this first half of the year, but in both directions.